What's happening, my digital disruptors? Welcome back to the Do.Different.Better show, where we transform your financial questions into money moves. I'm your host, Elaine Rasmussen, CEO and founder of Social Impact Now, Connect Up Institute, and managing director of the Integrated Capital Fund. Thank you for tuning in today. Today's topic, we're going to be diving into a topic that's really changing the way that we think about how we actually manage our money. That is digital only banks, or what are called neobanks, versus traditional banking. This conversation is really critical, especially for millennials and Gen Zers who value convenience, flexibility, and cutting edge technology when it comes to managing their finances, as well as accessibility. With the onset of more people becoming digital nomads or people living part time in other countries, it's really important to them that no matter where they are in the world, no matter what time zone that they're in, that they're able to do their banking. So, whether you're opening your first account or reconsidering your current banking options, knowing what's available will empower you financially. Here's a fun fact. Did you know that over 40% of millennials and Gen Z primarily bank online and are really more comfortable opening accounts on their smartphones rather than stepping into a traditional bank or talking to a human? I know that might be strange for some of us who maybe had a cord on our phones growing up, but this is really about the new younger thinking around how people want to interact and the accessibility, as well as being able to get things done quickly off hours, right? The future of banking clearly is digital, but does that mean traditional banks are out? Well, we're going to unpack that together on today's show. So, first, let's define what is a neobank. Neobanks are just that. They operate exclusively online. There are no physical branches. They are fully digital, which means you can handle all of your banking from your smartphone or a tablet or computer, and that is anytime and any place. There's some really popular examples that include banks like Chime or SoFi or Revolut or Ally, Vero, and Current. You've probably seen their ads pop up on your social media feeds promising simplified, fee-free banking experiences. Neobanks offer several key advantages that make them hugely popular. Zero or minimal monthly fees, such as or no hidden fees or complicated fine print. They often give higher interest rates because they have lower overhead costs. They often pass those savings on to you through higher yield savings accounts. So they also offer superior user experience as well as easy to use, tech savvy, younger thinking about younger consumers in mind. They also offer quick account setup. You can often set up a fully operational bank account within minutes right from your phone. But of course, as always, I'm going to keep it 100. There are a few things to watch out for. There are no physical branches. So if you prefer an in-person customer experience, you won't get that with a neobank, right? Or if you like to build a relationship, you really want to know somebody at the organization, at the financial institution, that kind of opportunity is really limited. Many neobanks also don't offer services like mortgages or complex business loans or investment management. And those might be things that you might need on top of having your bank account. In this instance, you always need a reliable internet connection, which can sometimes leave you stranded without access to your accounts if your connectivity fails or you're in a particular country that might be going through some infrastructure troubles. I remember when I went to the Dominican Republic a couple of years ago, it was literally a couple days after the big hurricane that blew through there. Now, where I was staying had their own power grid, but had that not been my situation and I had digital only banking, that could have presented a problem, particularly if there was a problem with my account or being overdrawn or something like that. I wouldn't have been able to resolve it in a timely manner because I was going to be in the Dominican for 7 days. Now, let's talk about the flip side. That is, traditional banks and credit unions are really the familiar institutions that have physical branches scattered throughout your city. Think about Greenwood, First Independence Bank, PNC, Chase, Bank of America, Wells Fargo, and there's many others. These banks offer face-to-face interactions and a broad suite of financial services. But traditional banks come with their own strong set of advantages. One, they have physical branches. These are ideal for complex transactions or for anyone who prefers a personal touch, or if you have a situation that really needs to be talked about in person and not necessarily over a chat or with a chat bot. They also provide comprehensive services. So, not just checking and savings accounts, but they can also provide mortgages, auto loans, business loans. Traditional banks are usually a one stop shop. Another thing that you can get that's an advantage with a traditional bank or credit union is established trust and security. These banks have been around for decades, even sometimes centuries. They offer FDIC insurance. So um, that is the insurance that says that up to $250,000 will be guaranteed in your account should anything happen with the bank, if there's any kind of failure. And that also provides a deep sense of stability. But once again, however, traditional banking isn't without its own downsides. So, one, they could be higher fees. Traditional banks often require minimum balances, and there are more hidden fees or maintenance fees as compared to a neobank. They also tend to have lower interest rates. Savings accounts at traditional banks typically have much lower yields. And then finally, there is slower technology adaptation. Although many traditional banks now have mobile apps, they often lag behind in user friendliness and cutting edge features, potentially making your banking experience um, more intuitive or easy to interface with. However, in both cases, these financial institutions have little, if any, connection to investment in your community, with the exception of credit unions, which are specifically designed to serve a membership or group of people like teachers, firefighters, employees of a specific company or geography, as well as keep dollars circulating locally. So, as we consider the differences between neobanks and traditional banks, it's clear each one of them has their unique advantages, and they need to be suited to find your financial goals and your particular lifestyle. So, really, I want you to think more broadly about this conversation. When we think about, I always like to ask the question, where's your money sleeping at night? And how is it being activated to your advantage and what your goals are? So, as I mentioned earlier, one of the things that you want to think about is it really important to you that the financial institution is investing in your local community? Is it important to you that maybe they are invested in certain things or not invested in other things? If you have divestment as part of your investment plan or your financial goals or your financial vision for your money for your portfolio, then these are things where you might want to go and do some additional research. And some of this research can be as simple as Googling. One of the things that I like to recommend folks that I'm counseling around money is look up the bank literally on Google and say, bad press plus whatever the financial institution is. Then you can start to get what are all the things that they've received bad press about. And that gives you a good opportunity to look and understand what are they doing and are any of those things a problem for you? Do they give you heartburn? Do you think it's going to keep you up at night? Is that what you want to be associated with? Is that what you want to be associated with? On the flip side, I would say do the same thing as far as looking at what are the things that they've been recognized for? What are the things that they've been praised for? Once again, you go into your browser of choice, your search engine of choice, and put in whatever the financial institution's name plus good press or accolades or achievements, and that's going to give you another list of different URLs that are going to tell you what the organization has done really, really well, or what they've been noted for, or what their philanthropy looks like, or what their give back to community looks like. So that's just a high level thing that you can do that's easy, accessible. But if you really want to go deeper, some of these organizations are publicly traded. And if they're publicly traded, and I've done an episode on that, you can actually go and find out How do they spend their money? What executives are getting paid? You can get more of this information by looking at their investor relations report. Most organizations will have that on their website. It's way, way, way down. Scroll to the bottom of the website and put in investor relations in the search bar, or they might have a corporate responsibility or a press section. In that section is where you can get access to the investor relations information, which will give you historical information about that particular organization. Now, not every financial institution provides that, but if that's something that's important to you, is transparency, then that might help you make a decision as to where you might want to align your money with your values and where you're actually investing your money, whether it be a savings account, a business loan account, a mortgage, or an auto loan. So, as we wrap up this segment, here's your first action step that I'm going to provide for you. Think about what matters most to you in a banking partner. Is it convenience? Is it high yields? Or do you really value having somebody that you can talk to, who knows you, who you can go back to time and time and time again, and or has broader financial offerings? I want you to write them down. I hope you're keeping like a little finance notebook, and you can put this in there. Jot down your top banking needs. And as we move into the next segment, you'll be ready to start making some informed choices based on some information I'm going to be giving you. So, you're listening to Do Different Better. I'm your host, Elaine Rasmussen. Stay tuned because up next, we're going to dive into specific features that you should look for in a neobank and how traditional banks are evolving to compete. You're not going to want to miss it. And don't forget to hit the subscribe button if you're new to the show. Welcome back, my digital disruptors. You're tuned into the Do Different Better show, where we're unpacking all things money and making sure your financial choices reflect your lifestyle, goals, and values. I'm your host, Elaine Rasmussen. In the first segment, we laid out what digital-only banks are what they are and compared them to traditional banks, the brick-and-mortar institutions. But knowing the difference is just the first step. The bigger question is, which one is right for you? In this segment, we're going to take a deep dive into 3 key factors that matter the most when choosing between digital banks and traditional ones: convenience and accessibility, fees and hidden costs, and security and trustworthiness. By the end of this segment, you're going to have clarity on exactly which banking model matches your unique needs. So let's get into it. First up, let's talk about convenience and accessibility. These days, everyone is juggling careers. They're busy, their side hustles, their families, their life goals. Maybe there's somebody else you have to care for. Your bank should fit seamlessly into your life, not add additional stress. Neobanks, or digital-only banks, are built on convenience. And here's how. 1, instant account setup. Imagine this. It's 11 o'clock at night. You're doom scrolling through Instagram and you see a financial influencer recommending a savings account with a high yield. With a traditional bank, you'd have to wait until the morning, maybe even schedule an appointment, drive to the branch, deal with traffic, and then the thing that we love, paperwork. Ugh. With a neobank, you can download the app, snap a picture of your ID, and enter basic information, and voila, your account is set up in minutes. Companies like Chime and Revolut and Current excel at this instant access, making it really, really easy to start saving or budgeting almost immediately. They also have sometimes budgeting tools that you can use that are embedded in the app that can help you, or monitoring to help you limit your spending and other things like that that can help you manage your financials. But also, they offer 24/7 banking. Digital banks never close. Need to transfer money in the middle of the night? Done. Forgot to freeze your lost credit card at 3 a.m.? You can do that too. It's banking without boundaries. and it's ideal if your lifestyle isn't 9 to 5. Neobanks also, they are very sleek and fast and easy to navigate because they are apps. They are designed specifically for smartphone use, meaning you can manage everything, pay your bills, set up savings buckets, track your spending in just a few taps. Younger generations, particularly millennials and Gen Z, value intuitive technology as part of their everyday experience, which explains why their digital first solutions resonate so strongly. But convenience has another side, and that's accessibility. If you live in a bustling urban center or metro area with great interconnectivity, neobanks are almost unbeatable. However, if you're located in a rural or third ring suburb, internet stability could be an issue. No internet means limited or no access to your account, which is the same as if the bank was closed, which this can also create some real frustration and in crucial financial moments that don't serve you. This is where traditional banks actually shine. One, they have physical branches. Having the option to speak to a real person face to face still matters. For complex transactions like mortgages, business loans, even resolving account issues quickly, physical branches can provide comfort and clarity. And if you're someone who appreciates a personal interaction or has financial needs that frequently require detailed conversations, traditional banks like the big banks like Chase or Wells Fargo or PNC or your local community banks may offer peace of mind that digital alternatives cannot replicate. Then there's the ATM network. The many ATM networks are national, meaning it's easier to make cash withdrawals, often without any fees. Digital banks often have to frequently partner with existing ATM networks, but their reach can vary, and particularly if you're looking about traveling outside of the country. With traditional banks, you can generally know exactly where you can access, you know, access your cash fee-free, providing convenience, especially when traveling domestically or internationally. Um, that can be a challenge sometimes with community banks because they might not also have some of those partnerships. So the bottom line on convenience and accessibility is if your life is digital first, you thrive on speed and ease of use and prefer managing finances entirely online, neobanks could be your best bet. On the other hand, if you like face to face interaction, branch access, reliable cash, availability, that's more important to you, traditional banks may still hold a significant advantage. Take a moment now and think about what matters most to your particular lifestyle. And think about not just for today, but think about in your near future. If you know that you're going to get a promotion and you're going to be traveling a lot, having different kinds of access might be important to you. Okay, let's get into part two of this. Let's talk about fees and interest rates and hidden costs, three factors that directly impact your wallet. Let's start with the digital first approach to neobanks. One huge selling point is that their promise of low or no fees. How does that actually work? When you think about they're sometimes offering fee-free checking. Neobanks typically offer checking accounts without monthly fees, overdraft charges, or minimum balance requirements. Banks like Chime and Ally have practically built their entire marketing strategy around fee transparency. For younger users or those just getting started financially, avoiding these fees can save hundreds of dollars a year. Next, higher interest rates. Neobanks frequently advertise attractive interest rates on savings accounts, often significantly higher than traditional banks. Consider this example. Imagine placing $10,000 in a traditional bank savings account at an average rate of 0.5%. After a year, you'll earn about $50. Place that same $10,000 in a neobank offering 4%, your interest jumps up to around $400 a year. That's 8 times more. Over 5 or 10 years, that difference adds up to thousands and thousands of dollars. So remember, a few episodes ago, I talked about how when I bought a car through a credit union, I had to open up a savings account with that credit union, and the savings account had to be opened with $5. 7 years later, I didn't put any additional money into that bank account, but because of the interest that accrued, I now had $150, and I didn't have to do anything. That was all compounded interest based on money put in that account. Now, just imagine if I had added money into that account, it would have continued to grow. So it's easy to see why neobanks are appealing if growing your savings quickly is a priority. Next, let's talk about transparency. Digital banks are usually very upfront about their fees, that almost always they're just listed on the website. They clearly outline costs for services like international transactions, overdrafts, or wire transfers. Their business models rely heavily on trust, so transparency is a core value. On the flip side, let's look at the fees and costs associated with traditional banks. Many traditional banks charge monthly maintenance fees unless you meet specific criteria, such as a minimum bank account, minimum bank account balance, direct deposits, or multiple accounts with the institutions. These fees can range anywhere from $5 to $15 per month or more. Over a year, that's potentially $60 to $180 gone just for having your money sit there. Next, overdraft fees and ATM fees. Traditional banks often charge overdraft fees averaging $35 per transaction. Even with overdraft protection, the fees can quickly add up. ATM fees are another consideration. If you frequently withdraw cash from non-network ATM banks, you could be losing significant amounts of dollars yearly in charges. Then, as I mentioned, traditional banks typically offer lower interest rates on savings accounts and checkings accounts, meaning your money is going to grow slower over time. So, when it comes to fees and interest, neobanks have a clear edge for users who prioritize savings growth, cost transparency, and fee avoidance. However, if your financial strategy includes significant cash handling and you're already comfortably meeting traditional banks' fee waiving criteria, then sticking with a well-known traditional bank could make more financial sense for you. Now we're going to get into the last part of this segment. Let's talk about something that we all deeply care about, and that is, particularly in this day and age, security and trust. After all, what's the point of convenience or low fees if your money isn't safe? But the good news first. Both traditional and digital-only banks offer FDIC insurance protection, which is up to $250,000 per depositor per institution. That means even if the bank fails, your money is safeguarded. Now let's switch to digital banks have a robust cybersecurity. So often this is really an aspect in older and legacy banks that might need some work. Neobanks utilize advanced encryption, multi-factor authentication, and real-time fraud detection tools. Since they operate entirely online, they invest heavily in digital security measures to protect customers and their brand reputations. Now let's talk about reliability and trust. Traditional banks hold significant advantages in terms of trustworthiness and reliability simply due to their longevity. Big brands like maybe your local community bank, which has been around for a long time, or some of the larger big banks like a Bank of America, a JP Morgan, or a Citibank, they have existed for generations in one iteration or another. Names have changed, but the essential organization is the same. Customers will feel typically more confident in trusting into their financial matters like mortgages and retirement planning to these larger established entities. Neobanks, being newer, are still proving themselves in the market. While many have earned solid reputation, skepticism remains, particularly with older generations. Younger generations may trust these platforms really easily because they've grown up on the internet. But those accustomed to traditional banking could view them with a lot of skepticism and caution. So, what's the bottom line on security and trust? If brand stability, physical presence, and legacy give you a solid peace of mind and warm and fuzzies, then traditional banks are going to be a solid choice for you. Or if you're not sure, you're new, maybe you start off with a traditional bank, you have a savings account with a digital bank, and then you kind of see how's it going. However, if you're comfortable in a digital first environment and you trust modern tech and security practices, digital banks only provide you with that robust and security with their services. So, now to sum it all up, choosing between a digital only bank and a traditional institution boils down to your unique needs and lifestyle. Evaluate your priorities. Is convenience king, or does trust and in person interaction matter most to you? Are fees your deal breaker, or are you more concerned with physical accessibility? Having somebody that you know and trust that you can talk to and call up on the phone when you have questions, concerns, or an issue. Either one is going to be fine. And like I said, you can start off maybe with a hybrid. Start thinking about maybe you do both at the same time and see how it goes, especially if you're new. This happens a lot with new Americans. This is a great way for them to really think about, for you, if you're a new American, to think about, hey, I'm going to try both and see what makes me feel comfortable. Maybe English isn't your first language. So having to go into a physical bank where you can talk through something patiently as you think through it, maybe that going with a traditional brick and mortar bank is going to be the thing for you. So, coming up next, we're going to explore how digital banking is evolving, what's next for traditional banks, and how you can strategically use both to your advantage. Stick around because the future of financial services is fascinating and it's happening right now. We're going to be back after the break. You're listening to Do Different Better. I'm your host, Elaine Rasmussen, and stay tuned. I can't wait to see you back after the break. Welcome back, my financial futurists. You're listening to the Do Different Better show, and we're exploring how to make smart banking choices that align with your life and values. I'm Elaine Rasmussen, your host, helping you navigate the financial landscape clearly and confidently. In our first two segments, we've broken down the differences between digital only banks, also known as neobanks, and traditional banks or brick and mortar banks. We evaluated their convenience, their accessibility, the fees, the interest rates, security, and their trustworthiness. Now let's shift gears and look forward. What does the future hold for banking? And more importantly, how can you leverage these trends to thrive financially? We're diving into emerging trends, examining hybrid banking models, and giving you actionable tips to optimize your financial strategy for the future. But let's kick things off by looking at some fascinating trends and predictions in the financial services sector. First, let's talk about the rise of digital banking and why this should even matter to you. The digital banking revolution isn't coming, it is already here. And it's changing the way we interact with money in so many significant ways. I mean, just think about, I don't know who's listening right now, but I know for me, there was literally no PayPal growing up. PayPal wasn't a thing until I was well into my professional career. Venmo is a relatively new innovation. The fact that when I go to get my massage, I pay my masseuse via Venmo. You could actually set up a whole business on PayPal. You can send out invoices, you can receive money, you can send money. And there's so many things like Zelle and Cash App that is making doing financial transactions so much easier. I know for me, I've tipped. I've done my tip because I don't carry cash, so I'll Venmo tip to my manicurist as opposed to making sure I go to the bank and I have cash available to me, or taking cash out when I go, getting cash back when I go to the grocery store. But now let's really dive into specifically what are the trends that we're seeing. Here's the first trend. Younger generations are driving massive adaptation to mobile first banking. Millennials and Gen Z, which are the largest segments of the population, are demanding convenience, flexibility, and seamless digital experiences and integrations into other parts of their life. These generations have grown up with smartphones, the internet access, and immediate information at their fingertips. They're less inclined to visit a physical branch, and they prefer instant digital solutions. For instance, over 80% of Gen Z consumers have opened up their first bank account online, compared to fewer than 50% of baby boomers. This generational shift indicates a significant move towards digital banking as a default rather than an exception. Trend number two. Artificial intelligence and machine learning are reshaping how financial services operate. Expect your bank to become a more proactive financial assistant rather than just a passive money holder. Imagine logging into your banking app and having an AI powered financial advisor predict your monthly expenses, suggest budget adjustments, identify some spending patterns, whether they be good or bad spending patterns, or even automate your savings goals effortlessly. Banks like SoFi and Ally and Chime are already beginning to integrate these personalized AI services to improve your customer service experience. I think on the show, we've also talked about platforms, investment platforms like Betterment and others. JP Morgan are adapting some of these to their platforms. And here's the third trend. Cryptocurrency integration into mainstream banking. Love it or hate it, cryptocurrency is not disappearing. Digital banks are increasingly incorporating crypto wallets and investment options directly into their platforms. Revolut and Robinhood are two pioneers in this space. They are offering seamlessly combining traditional fiat currencies with crypto investments. Even traditional banks, once skeptical, are cautiously moving toward digital currencies. JP Morgan Chase and Bank of America have set up dedicated crypto research teams, recognizing the growing consumer demand for digital asset integration. Next is data insight. Here's a number that should capture your attention. By 2030, industry experts predict digital-only banks could control up to 30% of global banking market share. That means nearly a third of all consumers worldwide could rely primarily on neobanks. This monumental shift will pressure traditional institutions to innovate and adapt rapidly, ultimately changing banking for everyone, everywhere. So, why does this matter now for you right now? Understanding these trends gives you the advantage of being ahead of the curve. It helps you anticipate changes in how you'll manage your finances, invest, and interact with your banks. Given these transformative trends, let's discuss a practical strategy that smart consumers are adopting today: the blended banking approach. A blended banking approach means combining the best features of a traditional bank with the advantages of digital-only bank. Think of it as creating a customized financial system tailored precisely for your unique needs and lifestyle. Let's explore how you can effectively do this. So, one major trend we're seeing is traditional banks increasingly adopting digital first strategies. Big name banks such as Chase and Wells Fargo and Citibank are investing millions in improving their mobile apps and digital interfaces. They're also trimming down physical branch locations, reflecting evolving customer preferences, which also lowers their cost. Simultaneously, digital-only banks are beginning to partner with traditional financial institutions to offer a broader range of services. For example, digital banks like Chime are partnering with established FDIC insured banks, providing customers with peace of mind, safety, and the same federal protections that traditional banks offer. So, what does this mean for you practically? Here's how to blend banking effectively. One, maintain a traditional bank account for complex, high value financial products and services. We're talking, for instance, like your home mortgage, your car loans, your business financing, usually still have better options through established banks, primarily because they have the resources, the regulatory frameworks, and the lending history that make loan approvals much more straightforward and secure. Utilize a neobank for your day-to-day banking needs like checking and savings or budgeting and smaller transactions. Digital banks excel at these routine tasks, typically offering no fees or intuitive apps, higher savings rates, yields, interest rates, and superior customer-friendly interface. Imagine this scenario. You maintain a mortgage and business accounts with your local credit union or traditional bank, leveraging their established infrastructure and personal relationships that you may have with the employees or bank manager there at the brick and mortar location. Meanwhile, your daily spending, your checking account, your emergency savings reside in a digital bank, giving you maximum flexibility, lower cost, and easy access via mobile apps. This strategy offers the best of both worlds: reliable, low cost daily banking and secure, robust financing for major life milestones. So, let's put this blended strategy into action today. First, assess your current banking setup, not only just the physical banking setup, but even philosophically. Remember when we talked about where does your money sleep at night? Is your money in a place that is actually serving you, invested in the things that are important to you, and supporting your community? If those are things that are important to you, that's also something that you might want to look at and do some research on. And you can do that even if you haven't opened the bank account yet. You can do that research to see and understand. And there's some great YouTubers and online resources to understand how best to do that kind of research and land on a decision. But let's get back to what we're talking about today. First, assess your own current banking setup. Where is your banking and checking and savings account now? Right? You may not even know. You may have a savings account. You're like, I opened that years ago. I don't even know what's in it. I don't know who it is, or that bank may have closed. So then you're going to have to go through the process of getting that money. And there is a legal process to get money from a bank that has closed. Where do you hold your loans and your mortgages? Ask yourself if your setup meets your needs in terms of convenience, in terms of fees, in terms of savings rates, and in terms of customer service. You may want to think about either creating a spreadsheet or maybe just using pen and paper and create quadrants, right? And maybe rank all of those things in a 1, 2, 3, 4, 5. Is it a 1 convenience, but it's a 5 for usability or accessibility, right? Those are the ways that you can start to maybe think about comparing apples to apples for each one of your particular accounts that you're holding, and then you can use this as analysis for when you're going to be doing, making your decision. But then consider reallocating your banking services to match your lifestyle and financial goal. But once again, you're going to need to get clear about what those lifestyle and financial goals are. Is your lifestyle goal that you want to be a digital nomad and you want to live in a different country every 3 months? Well, that's going to play into your decision as to where and how you're going to set up your banking, right? Are your financial goals is to build compounded interest in a very short period of time because maybe you're later in life and you really want to move up your hitting your financial goals? Or are you looking at the slow and steady wins the race approach? Either one is fine, but it's important for you to get clear about which one of those is important to you. Okay, now let's get down to the practical. Here is a clear step-by-step tips on how you can start optimizing your banking strategy today. Step 1, choosing the right bank. If you're considering a neobank, Research and compare digital platforms like Chime or Ally or whichever ones that you're looking at. You can go once again and go into your favorite search engine and say, give me a list of 5, or you can go to some trade organizations and see which ones are listed as the top 5 or top 10. Look specifically at their user interface, customer service ratings, interest rates, fee structures, and security measures. For traditional banks, identify which ones meet your needs for complex products like mortgages, business loans, or comprehensive financial planning. Step 2, set up automatic systems. Once you've chosen your bank, automate your finances for efficiency. This is going to include direct deposits. Have your paycheck automatically deposit into your chosen account. For your automatic savings transfers, schedule regular transfers from your savings to your checking, from your checking to your savings accounts, and make sure that they are out of sight and out of mind. That's going to help you be less likely to go and be like, oh, I just need $20. One of the things from my previous partner, my son's father, at one point he was taking out $20 every single day, and because the ATM was literally right around the corner for his work, so he'd pull out $20 to go have fast food lunch. And I eventually had to tell him, you're ATMing us to death. $20 a couple times a week after a month, you think about that's $40 a week times 4 weeks in the month. That's $160. $160 times 12 months in a year. That's a lot of money over time. So what's really great about having something automatically set up is it allows it to happen without you even having to think about it, right? Now let's think about investment contributions. Set up automated contributions to your investment or retirement accounts, maximizing growth potential without extra hassle. Step 3, leverage technology. Take advantage of mobile banking apps to track your spending, set financial goals, and monitor your progress. These apps are excellent for accountability and helping you see exactly where your money is going and where adjustments need to be made. Here are 3 reliable resources to further research. NerdWallet is a great website to be able to access information about digital banks as well as traditional banks, and Bankrate. They are great tools for comparing banks, financial products, fees, and interest rates really quickly and transparently. Then there's Forbes Advisor. It offers extensive reviews and comparisons, in-depth guides to help you choose the right financial products and banks for you. So I hope you've taken a lot away from this, and it's given you some questions about your current banking situation, the platforms that you're using, the bank that you're using, whether it's a local bank, whether it's a credit union, whether it's a big bank, and really thinking about what is important and valuable to you across multiple different aspects of your life. So I'm hoping that you are now better suited and thinking more critically about all of those things. So to wrap it up, here is my call to action to you. I challenge you to review your current banking situation this week. Identify at least one improvement you can make, whether that's opening a high interest savings account with a neobank, or setting up an automatic investment transfer, or simply evaluating your banking fees. Remember, your financial future is shaped by the choices you make today. Banking doesn't have to be passive. It can be actively contributing to achieving your goals and dreams. So, if today's episode has helped you gain clarity, I'd love for you to share it with a friend or a family member or a colleague and tell them, especially if they've made a comment about neobanking or not trusting a digital bank, maybe send them this episode to give them a little bit more information. Or if you have somebody who's only considering a digital bank and doesn't think that traditional banks or brick-and-mortar banks are useful, send this to them to help them understand how they might be able to leverage the benefits of a traditional bank in ways that they never thought of. I'm hoping that you connect with us on social media using the hashtag Do.Different.Better, or you tag me in your comments at Do Better with Elaine on Instagram, and let me know what your biggest takeaway has been from the show. Thanks for joining me today. I hope you've learned a lot. Keep challenging the status quo and keep asking the right questions to keep thriving and reaching your financial goals. Don't forget to hit the subscribe button and share this with somebody you know who's thinking about opening a first or alternative bank account. Tell me what you think of the show, and remember that you can watch the show on YouTube at Do Different Better. I'm Elaine Rasmussen. Until next time, let's do different better together.